What are some examples of tail risk hedging strategies? Have you ever wondered how investors protect their portfolios from unexpected market downturns? Tail risk hedging strategies are designed specifically for this purpose. They aim to shield investments from extreme market events that can lead to significant losses. Let's break down some effective strategies you can consider. First up is buying out of the money put options on equity indexes or individual stocks. This method allows investors to purchase options that give them the right to sell at a price lower than the current market value. These options are usually inexpensive during stable market conditions. However, when markets take a sharp downturn, their value can soar. This increase helps offset losses in your portfolio during those tough times. A smart approach is to select a mix of liquid, affordable put options on large and mid-cap stocks. This can create a strong hedge, especially when market correlations rise during crises. Next, we have tail risk exchange-traded funds. Certain exchange-traded funds are specifically designed to manage tail risk. They typically hold a combination of long-dated of the money put options on broad market indexes along with safe fixed income assets like United States Treasury bonds. For example, the Cambria Tail Risk Exchange Traded Fund invests mainly in United States Treasury bonds while allocating a smaller portion to long put options on the Standard & Poor's 500 index. This setup aims to provide protection during market crashes while minimizing losses during stable or rising markets. Another strategy involves using options or futures on volatility indexes, such as the Volatility Index. These instruments tend to gain value when market volatility spikes, which often happens during market declines. By purchasing call options on the Volatility Index, you can create a hedge against sudden increases in market uncertainty. Additionally, diversifying into foreign assets or holding cash can also help reduce exposure to a single market's tail risk. Holding cash gives you the flexibility to invest in undervalued assets after a market downturn. Lastly, some advanced strategies combine multiple tail hedging techniques. This could include a mix of diversified put option portfolios, volatility option strategies, and rules to control drawdowns. By diversifying within your tail hedging approach, you can improve your risk-return profile compared to relying solely on index put options. Keep in mind that while tail risk hedging can be effective, it often comes with costs. These strategies may lead to negative returns during long bull markets, since you are paying premiums for insurance that might not be needed frequently. However, during severe market downturns, they can significantly reduce losses and provide capital to reinvest at lower prices. Incorporating these strategies into your investment plan requires careful selection of instruments and ongoing management to balance protection costs with potential benefits.